Could silver really hit nearly $4,000 an ounce? It sounds crazy, right? But what if I told you there's a historical model that suggests it's not just possible, but logical? Today, we're diving deep into an incredible prediction by Tavi Costa, a portfolio manager at Azuria Capital. To understand where this wild number comes from, we have to go back in time. Let's travel to the early 1930s, during the Great Depression. The US was on the gold standard, meaning the value of the dollar was directly tied to a specific amount of gold. Back then, the government was legally required to hold enough gold to back 40% of the currency in circulation. This created a rigid system. As the economy struggled, the government needed to print more money to stimulate growth, but their hands were tied by the amount of gold they held in their vaults. Imagine the government's balance sheet like a household budget. On one side, you have assets, in this case, the gold reserves. On the other side, you have liabilities, the currency in circulation and mounting government debt. As the Depression worsened, the debt was piling up, but the value of their main asset, gold, was fixed at just $20.67 an ounce. The scales were tipping dangerously. The government's liabilities were becoming much larger than its assets could realistically support. Something had to give. This is where President Franklin D. Roosevelt made a game-changing move. In 1934, with the Gold Reserve Act, he did something radical. He repriced gold. Overnight, the official price was raised by nearly 70%, from $20.67 to $35 an ounce. Why did he do this? It wasn't just to devalue the dollar, it was a strategic rebalancing of the nation's books. By increasing the value of the gold on their balance sheet, they effectively restored the ratio between their assets and their liabilities. It was a monetary reset. They couldn't magically increase the amount of gold they had, so they increased its price instead to reflect the new reality of their expanded debt and money supply. This single act allowed the government to continue its spending programs and navigate out of the Depression. Now, let's fast forward to today. Ms. Tavi Costa argues that we're in a very similar situation, but on a much, much grander scale. Look at the US government's debt. It's not just billions anymore, it's trillions upon trillions of dollars and climbing at a breathtaking pace. On the other side of the balance sheet, we have the US Treasury's gold reserves, which amount to about 8,133 tons. The crucial point is that this gold is still officially valued on the books at a laughably outdated price of just £42.22 an ounce. This price was set back in 1973 and has never been updated. So we have a situation where U.S. government liabilities, primarily the national debt, are skyrocketing, while the value of its primary monetary asset, gold, is being accounted for at a price from 50 years ago. The gap between assets and liabilities is astronomically wider than it was in the 1930s. Tavi Costa's core argument is this. Just as the government repriced gold in 1934 to reflect the reality of its debt, it may be forced to do so again. Let's do the math. If we were to revalue those 8,133 tons of gold to a level that provides a similar 40% backing for the current U.S. government debt, what would the price of gold have to be? The calculations are staggering. Depending on the exact debt figures you use, the implied price of gold would need to be somewhere between $50,000 and $80,000 per ounce. Yes, you heard that right. Not $2,000, not $10,000, but upwards of $50,000. This isn't a prediction of the market price tomorrow, it's an accounting reality. It's the price gold would need to be to rebalance the government's own books, just like in 1934. Now, you're probably thinking, okay, that's a crazy number for gold, but this video is about silver. Where does the $3,140 for silver come from? This is the next logical step in the analysis, and it hinges on the historical relationship between gold and silver. Throughout history, gold and silver have moved together, maintaining a relatively predictable ratio. This is known as the gold to silver ratio. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has fluctuated, but it has often hovered around certain levels. In ancient Rome, it was about 12 to 1. In the 19th century, it was often around 15 or 16 to 1. In modern times, it's been much higher, sometimes exceeding 80 or even 100 to 1. Tavi Costa's model makes an assumption about where this ratio will head in a future monetary reset. He looks at historical precedents and suggests that the ratio could revert to a much lower, more traditional level. For his calculation, he uses a ratio of 15 to 1. This is a very important assumption. The idea is that in a world where gold is revalued to its true monetary value, silver, as the other primary monetary metal would be pulled up along with it, and their relative value would return to a more historically normal level. So let's connect the dots. We start with a potential revaluation of gold. If we take a conservative estimate from that massive range, say a repriced gold value of $60,000 per ounce, and then we apply the historical gold to silver ratio of 15 to 1, what do we get? We take $60,000 and divide it by 15. The result is $4,000 per ounce of silver. And that is precisely how Tavi Costa arrives at his eye-popping figure of $3,147, using his specific inputs for debt and reserves. It's a multi-step process. First, acknowledge the massive and growing imbalance between U.S. government debt and its officially priced gold reserves. Second, recognize the historical precedent of the 1934 Gold Reserve Act, where gold was repriced to solve this exact problem. Third, calculate the new gold price required to achieve a similar balance today, which leads to figures in the tens of thousands. And finally, apply a historical gold to silver ratio to derive a corresponding price for silver. Now, it's critical to understand what this prediction is and what it isn't. It's not a short-term market forecast saying silver will hit this price next week or next year. It's a long-term, structural argument about a potential monetary reset. It suggests that the current financial system built on ever-expanding debt is unsustainable. At some point, there may need to be a great reset, similar to what happened in the 1930s, where the value of real tangible assets like gold and silver is officially recognized at a much higher level to account for the mountain of debt that has been created. Of course, there are many counter-arguments. Critics would say that the world is no longer on a gold standard, so this comparison is invalid. They would argue that the US dollar's strength comes from its status as the world's reserve currency, not from any backing by gold. They might also say that a government-led revaluation of gold is politically impossible in the modern era. And they would certainly question whether the gold to silver ratio would actually return to 15 to 1. These are all valid points to consider. However, the core logic remains compelling. Fiat currencies like the US dollar have a limited lifespan. History shows us that all unbacked paper currencies eventually fail. As governments continue to print money and accumulate debt at an accelerating rate, faith in those currencies can erode. In such a scenario, people and even central banks naturally turn to tangible assets with a long history as money, namely gold and silver. Tavi Costa's thesis is a powerful reminder that the laws of finance and accounting can't be ignored forever. Eventually, the books have to be balanced one way or another. What this analysis provides is a logical framework for why precious metals, particularly silver, could have an incredibly bright future. Silver is unique because it's both a monetary metal and an industrial metal. Demand is growing from industries like solar panels, electric vehicles, and electronics, while its monetary role has been suppressed for decades. If a monetary reset were to happen, and silver's monetary characteristics were recognized again, the price explosion could be even more dramatic than gold's, especially given the historically tight market. So, while $3,947 an ounce for silver might seem outlandish today, the path to get there is based on historical precedent and basic accounting. It's a thought-provoking scenario that forces us to question the long-term stability of our current financial system. It reminds us that in times of great financial uncertainty, history often provides the best roadmap for the future. You divide 20 trillion by 261.5 million ounces, and you get a gold price of approximately $75,000 per ounce. Now, is this realistic? Let me give you my honest take. The math is correct. I checked it. 20 trillion divided by 261.5 million ounces does equal roughly 75,000. And a gold-silver ratio of 19 has been hit before in history. So mathematically, the number checks out. But this is where I start asking harder questions. First question is 51% debt backing coming back? I don't think so. No government on earth is going back to a full gold standard. That era is over. The world runs on fiat currency and central bank credibility now, not gold bars in a vault. So using 51% as your baseline is the most extreme version of this calculation. But that doesn't mean the exercise is worthless. Far from it. Because even if you cut that 51% in half to 25%, gold would need to be around 37,000. Cut it to 18%, which is where we were in 1980, and gold would need to be 26,000. Cut it to just 10%, barely above where we are now, and gold still needs to be roughly $15,000 per ounce, 3 kicks from today. So the question isn't whether gold is undervalued relative to debt. It clearly is. The question is how much of that gap gets closed. And history says it always gets partially closed during periods of debt stress, 1933, 1980, and potentially now. That brings me to the second piece of Tavi Costa's framework, and honestly, this is the part I find most compelling. The Dow priced in gold. There's a chart that compresses over 100 years of market psychology into a single line. It's the Dow Jones divided by the price of gold. When this ratio is high, it means stocks are expensive relative to gold. When it's low, it means gold is expensive relative to stocks. And this ratio has a very clear pattern. It peaked in 1929, crashed into 1933, peaked again in 1966, crashed into 1980, peaked again in 1999 at an all-time high of 44.8. and it's been falling since then with a failed rally in between. Right now, the Dow-Gold ratio is 9.85, and this is the part that caught my attention. In 1973, right before the biggest gold bull market in modern history, the Dow-Gold ratio was at roughly the same level it is today, around 10. From there, it fell all the way to 1 by 1980. Gold went from 180 to 850, a 4-1-2x move. The pattern has repeated 3 times in 100 years. Every time stocks get extremely overvalued relative to gold, gold catches up every single time. And right now, we're sitting at the same starting point as 1973. Tavi Costa uses a target of 2.5 for this ratio, not 1, which was the extreme low, 2.5. He's aiming for the middle of the move, not the bottom. And I actually respect that approach because trying to catch the exact bottom is how you get killed in markets. If the Dow stays roughly where it is, around 49,500, and the Dow-Gold ratio drops to 2.5, that implies a gold price of roughly $19,800. The math is simple. 49,500 divided by 2.5 equals 19,800. Now, I ran my own version of this. What if the ratio only goes to 5 instead of 2.5? The point is, regardless of where exactly this ratio bottoms, gold has massive room to run based on a 100 red year pattern that has never failed to complete. And I think the assumption that the Dow stays flat is actually reasonable. In the 1970s, the stock market's low came in 1973, several years before gold peaked at the end of that decade. The Dow was basically flat for the entire decade while gold exploded. The same setup exists today. Stocks are overvalued, debt is exploding, inflation is sticky, geopolitical tension is escalating. That's not an environment where stocks rally hard. That's an environment where gold reprices against stocks. And there's something that Tavi Costa said that I think most people skimmed over but is actually critical. He said he doesn't think the real bottom in the Dow-Gold ratio was set in 2011, and I agree with him. After 2011, global debt didn't stabilize, it exploded. Every major economy printed money like there was no tomorrow. In past cycles, the Dow-Gold trough coincided with debt becoming manageable again. In the 1930s, debt was wiped out through deflation. In the 1970s, it was wiped out because inflation destroyed the real value of what was owed. Both of those processes were brutal. Both were great for gold and silver, and neither has happened yet in this cycle. The debt problem is bigger today than it was in 2011, which means the repricing cycle is not complete. We're still in the middle of it. Think about that for a second. If the 2011 gold peak wasn't the cycle bottom in the Dow-Gold ratio, then the move we're seeing now isn't a new cycle. We're not at the beginning of something new. We are deep in the middle of a massive cycle that kicked off all the way back in 1999 and still isn't finished. Understanding this one fact changes everything about how you should think about gold and silver price targets. This isn't a fresh start. It's the culmination of something that's been building for a quarter of a century. Now, let's talk about silver, because this is where things get both incredibly exciting and, at the same time, really controversial. The third and final piece of this puzzle is the gold to silver ratio. Right now, gold is trading above $5,100, and silver is above 84. That gives us a current ratio of roughly 60.7 to 1. When analyst Tavi Costa ran his numbers just a few weeks ago, gold was at 5,042, and silver was at 77, which gave a ratio of 65. What does this mean? It means the ratio has already started compressing. Today, 1 ounce of gold will buy you about 60 ounces of silver. That same ratio has been as high as 125 during the market crash in March 2020, and it's been as low as 14 back in January of 1980. Tavi Costa uses a target of 19 for this ratio in his model. His reasoning is that 19 is actually a conservative number relative to the 1980 low of 14. And to be fair to him, he's not using the most extreme historical data point. He's using a level that's above that extreme. But this is where I have my first real disagreement, and I want to be completely honest about it. A gold to silver ratio of 19 has only been hit once in the last 50 years. Just once in 1980, during the Hunt brothers era, when 2 billionaires were actively trying to corner the entire silver market. Before that, you have to go all the way back to periods when silver was an official monetary metal used in circulation for everyday transactions. Today, silver is not a monetary metal. Central banks do not buy it. They don't hold it in their reserves. It is primarily an industrial metal with investment demand layered on top. So, does that mean the ratio can't compress? Absolutely not. It compresses in every single precious metals bull market. But does it compress all the way down to 19? That is a huge assumption, and I personally think it's the most aggressive assumption in this entire framework. Let me show you what I believe is a more realistic scenario. In the 1970s bull market, before the Hunt brothers distorted everything, the gold to silver ratio bottomed out at around 30 to 35. During the 2011 silver rally, it got down to about 31. So a range of 30 to 40 seems to be where this ratio naturally wants to go during a major precious metals bull market without the influence of extreme speculative events. Now watch what happens to the numbers. When I adjust just this one assumption, this is the moment I started to really pay attention. In Tavi's version, you have gold at $19,800 and a ratio of 19. That gives you a silver price of $1,042. It's aggressive, but the math is sound. Now for my conservative version, we'll keep gold at $19,800. We'll use a ratio of 35. That gives you a silver price of $566. I looked at that number and thought, okay, that feels much more grounded in reality, but then it hit me. $566 is still a sevenfold increase from where we are right now. That's on the conservative estimate. Let's try a moderate version. Gold at $19,800, ratio of 25. Silver now equals $792. That's the middle ground. And it's still almost a tenfold increase. What if we get even more conservative? Let's say gold only reaches $15,000 and we use a ratio of 35. Silver still comes out to $428. I deliberately made every single one of my assumptions as boring and as conservative as possible, and I still got a silver price over $400. That's when the realization truly hit me. Every single version of this math, even the most pessimistic one I could create, gives you a silver price above $400. That's almost a 5 times return from today's price, and the aggressive version gives you over 1,000. So forget Tavi's highest number for a second. Even the boring, conservative version of this analysis says silver could go up 5 to 10 times from its current levels over the next 5 to 7 years. Now, I absolutely have to address the bear case, because if I only showed you the bullish math, I'd be doing you a disservice. And honestly, there's a very smart argument against all of this that I saw in the comments section of Tavi Costa's original post. When I read it, I had to pause because the person made a point that deserves a real answer, not just a dismissal. The argument goes like this. Tavi Costa is ignoring the supply side of the equation. If silver prices rise dramatically, mining becomes more profitable. More silver gets produced, and that increased supply will naturally push the price back down. The silver is a commodity, after all. It responds to price signals. You can't just extrapolate ratios without accounting for the fact that higher prices create more supply. It's a good argument. And the person who made it also pointed out that silver is a purely industrial metal today, not a monetary metal. You can't put gold and silver on the same level, they argued, because central banks buy gold, but they don't buy silver. These are all valid points, and I'm not going to dismiss them, but I am going to challenge them with data. Let's start with the supply argument. If higher prices cause higher mining output, which then causes prices to fall, then why didn't that happen in the 1970s? Gold went from $35 an ounce to $850. That's a 24 times move. Silver went from under $2 to $50. That's a 25 times move. Mining did increase during that period, but it didn't matter. The demand side of the equation was so overwhelming that supply simply couldn't keep up. Why? Because opening a new mine takes 7 to 10 years. Expanding production at an existing mine takes 3 to 5 years. The supply response is slow, the demand surge is fast. By the time any significant new supply comes online, the price has already made its major move. And I want you to really sit with that for a second, because this is the part the bears never have a good answer for. In the last 100 years, there have been 2 major periods where excessive debt was effectively wiped out. The first was the deflationary collapse of the 1930s. The second was the inflationary explosion of the 1970s. Both were catastrophic for paper assets. Both were incredible for gold and silver. And in neither case did increased mining supply prevent the rally. The macro force of debt repricing completely overwhelmed the micro force of increased production. It wasn't even a fair fight. Now look at what is happening today, because this is where it gets personal for anyone holding silver right now. Silver has been in a supply deficit for 5 consecutive years. Prices have tripled, and we still can't get enough silver to meet demand. Refineries are backed up with orders until April of next year. Major mints aren't even taking new orders. The largest bullion dealer in Singapore just reported 8-hour-long queues of people waiting to buy. And the COMEX vaults are being drained at a rate of 20 million ounces a month. The supply response isn't just slow. Right now, it seems to be going in reverse. This isn't just about a ratio on a chart anymore. This is about a physical market that is screaming for metal. The math, even the conservative math, points to a massive repricing. And the real-world data on the ground suggests that the squeeze is already on. Thanks for watching, and don't forget to follow for more updates. Today, we're diving deep into a topic that's been on a lot of people's minds: the gold and silver markets. You've probably seen the headlines and heard the buzz. Prices have been on a roller coaster ride, and it's got everyone asking, what is going on? And more importantly, what's next? So grab a coffee, get comfortable, and let's break it down together. First, let's talk about gold. For centuries, gold has been the ultimate safe haven asset. When economic uncertainty creeps in, when inflation rears its ugly head, or when geopolitical tensions rise, investors flock to gold like a port in a storm. And boy, have we had a perfect storm of all three recently. Central banks around the world have been on a buying spree, stockpiling gold at a record pace. This isn't just a few countries either. We're seeing a broad-based movement from major global players who are looking to diversify their reserves away from the US dollar. This massive institutional demand creates a very strong floor for gold prices. Think of it like this. When the biggest players in the game are all buying, it sends a powerful signal to the rest of the market. Now, let's add the inflation piece to the puzzle. We've all felt the pinch in our wallets, from the grocery store to the gas pump. When the value of our paper money is eroding, tangible assets like gold become incredibly attractive. It's a real physical store of value that can't be printed out of thin air. This is a classic economic principle that's playing out in real time. Investors are looking for ways to protect their purchasing power, and gold has historically been one of the best ways to do just that. Then there's the geopolitical situation. Global instability, trade disputes, and conflicts all contribute to a sense of risk in the markets. During these times, the stability and universal acceptance of gold make it a highly sought-after asset. It's not tied to any single government's policies or economic performance, which gives it a unique level of independence and security. When you combine this massive central bank buying, persistent inflation fears, and a shaky geopolitical landscape, you get the powerful upward pressure we've been seeing on gold prices. It's not just one factor, but a convergence of several major forces all pointing in the same direction. So, where could gold be headed? While no one has a crystal ball, many analysts are looking at key technical levels. Breaking through previous all-time highs was a huge psychological barrier. Now, traders are watching to see if these new levels can hold and become a new support base. If they do, it could set the stage for the next leg up. The sentiment is definitely bullish, but as always in investing, caution is key. It's important to watch for potential pullbacks and consolidation phases. These are healthy and normal in any bull market. All right, let's shift gears and talk about gold's more volatile and some would say more exciting little brother, silver. If you think gold's story is compelling, silver's is arguably even more so because it has a dual personality. Like gold, silver is a monetary metal, a store of value that people have trusted for thousands of years. It's often called the poor man's gold because it's more accessible to the average investor. When gold rallies, silver often follows, but usually with a lot more leverage. This is because the silver market is much smaller than the gold market, so it takes less money to move the price, leading to bigger percentage swings both up and down. But here's where it gets really interesting. Unlike gold, which is primarily a monetary asset, over half of all silver demand comes from industrial applications. That's right, silver is a critical component in so many of the technologies that are shaping our future. Think about solar panels. The green energy revolution is booming, and silver is an essential ingredient in photovoltaic cells. As the world pushes for more renewable energy, the demand for silver is set to soar, and it doesn't stop there. Electric vehicles, or EVs, are another huge driver of silver demand. From the batteries to the complex electronic systems, silver's superior conductivity makes it indispensable. Every smartphone, every laptop, every 5G tower, every data center relies on silver. It's in the circuitry, the connectors, and countless other components. This means that as our world becomes more electrified and more connected, the industrial demand for silver is structurally locked in to grow. This creates a fascinating dynamic. On one hand, you have the monetary demand from investors who are buying silver for the same reasons they're buying gold, as a hedge against inflation and uncertainty. On the other hand, you have this relentless and growing industrial demand that is consuming the metal, taking it out of the market for good. When you have rising investment demand meeting rising industrial consumption and a supply that struggles to keep up, you have the recipe for a potential price explosion. This is why many analysts are so incredibly bullish on silver's long-term prospects. So let's look at a key metric, the gold to silver ratio. This ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere around 40 to 50. In recent years, it's been much higher, sometimes even exceeding 80 or 90. When the ratio is high, it suggests that silver is undervalued relative to gold. Many investors watch this ratio closely. When it starts to fall, it means silver is outperforming gold, and historically, when silver decides to run, it really runs. We're starting to see this ratio trend downwards, which could be an early signal that silver is waking up and ready to close that gap. So, what does all of this mean for you as a potential investor? First and foremost, this is not financial advice. My goal here is to share information and analysis to help you do your own research and make informed decisions. It's crucial to understand your own risk tolerance. Silver, as we discussed, is more volatile than gold. Its price swings can be more dramatic. Gold is generally the more stable, conservative choice for capital preservation. One popular strategy is to hold a core position in gold for stability and a smaller, satellite position in silver for its higher growth potential. This allows you to have a solid foundation while also having exposure to silver's explosive upside. Think of it as a barbell strategy for precious metals. How can you get exposure? There are several ways. You can buy physical bullion, like coins and bars. This gives you direct ownership of the asset, which is a big plus for many people. You can hold it in your hand. It's tangible. However, you also need to think about storage and security, which can add costs and complexity. Another popular option is through exchange-traded funds, or ETFs. These are funds that trade on the stock market just like a regular stock, but they aim to track the price of the underlying metal. For example, there are ETFs backed by physical gold or silver stored in a vault. This is a very convenient and liquid way to invest, as you can buy and sell them easily through any standard brokerage account. Then there are mining stocks. This is a way to get leveraged exposure to the metal's price. When gold or silver prices go up, the profitability of mining companies can go up even more. However, this also comes with additional risks. You're not just betting on the metal price, but also on the company's ability to manage its operations effectively, deal with regulatory hurdles, and avoid issues like labor strikes or mine collapses. It requires a lot more research into individual companies. In conclusion, the current environment for both gold and silver looks incredibly strong. Gold is being driven by powerful macroeconomic forces, central bank demand, inflation, and geopolitical risk. Silver shares these drivers, but adds the massive tailwind of accelerating industrial demand from green energy and technology. The gold to silver ratio suggests that silver may have a lot of catching up to do, offering significant potential for outperformance. Whether you're looking for stability with gold or growth potential with silver, it's a fascinating time to be watching these markets. Do your homework, understand the different ways to invest, and decide what makes the most sense for your own personal financial goals. The story of precious metals is far from over. In fact, it feels like we might just be in the early chapters of a very exciting new book. Thanks so much for tuning in today. I hope this breakdown was helpful for you. If you got some value out of this video, please hit that like button and be sure to subscribe so you don't miss our future deep dives. I'd love to hear your thoughts in the comments below. What do you think is next for gold and silver? Let's get the conversation started. Until next time, take care and invest wisely.